Hey everybody, welcome to Spartan's First Friday. I'm Ryan Gibson. I got the pleasure of being here with Travis Watts from Ashcroft Capital. And today we're going to be talking about freeing up time through real estate syndications. And we're also going to be having a multifamily panel on the state of multifamily investing. So we're really excited to have a great group, Jared and Dylan and Travis, to talk about multifamily. We're going to do that right after Travis's presentation. We're just going to have a little chat about, I think what's interesting is how you have gone completely passive pretty much and started your passive investing journey in multifamily investing and then have invested in other operators. So before we get started, why don't we just tell us a little bit about yourself?
Yeah, cool. And just to clarify, first of all, thrilled to be here. Thanks for the invite. I was down in San Diego at a conference. You invited me. It just kind of worked out. So thrilled to be here. We've known each other for years. We've spoke on stage together. We've sponsored events together. A lot of parallels between Spartan and Ashcroft and what we do and the value add, pre-existing private placement kind of stuff. So when you say, full-time passive, right? I need to kind of further clarify that because I still work actively doing things I enjoy doing. But as far as being an investor, I started like a lot of people with single family homes, doing it all myself. I was the landlord. I did fix and flips. I did vacation rentals. I did house hacking. I had roommates. It was that kind of hands-on involvement for about 6.5 years. And it was actually a small real estate meetup, kind of like this one here today, where my life completely changed. It was around 2015. And I met a couple gentlemen that had sold their companies and became what's called a limited partner in syndications. Had no idea what that meant. Didn't realize what kind of value that really had. And it changed the entire trajectory and philosophy of what I do and why I do it. And started selling off all my single family homes. And I went fully passive. It took about 18 months to transition. And so when you say I'm fully passive, my portfolio of investments is 100% hands off, where I have no material involvement in the business itself of what's, occurring, much like buying a stock in Apple, for example, right? I don't work for Apple. I'm not an engineer at Apple. I'm not on the board of Apple. I'm a passive investor with a company like that. And I let the team do the heavy lifting. So,
and what was your first syndication? What was your first?
Yeah. So after meeting those gentlemen from the real estate meetup group, I didn't know what I didn't know. I was out in Denver, Colorado. So I said, okay, I'm going to find one of these syndicators. And I'm going to do a deal with them. And I went with a local group out of Denver. And so I was selling a property anyway. I had, I don't know, probably 75 in equity I was going to get. So I said, I'm going to take 50 and just do a syndication and see how that pans out, So just a local group, kind of a nobody group. And I wanted to make sure I wasn't going to get scammed. I wasn't about to just, dump my life portfolio into just something I didn't really understand. So I gave it about 6 months, find out it's the real deal, and then kind of fell in love with this passive approach, to investing. So
that's great. How'd that first deal go?
It went well.
Good.
It was, if I remember right, it was underwritten for about 5 years. We sold in about 2.5 years.
Perfect.
It was an Arizona deal. And it netted us about a 30% IRR, which was pretty strong. It was above exceeding projections. So,
well, great. Well, we're going to dive in to your story a little bit more detail. Talk about, kind of your philosophy and what you look for, kind of your life journey and getting into this space. And then, when we have the panel after this, we'll talk more about maybe brass tacks and what you do at Ashcroft and sort of how you help investors place capital and do what you do. So
cool.
Yeah.
I would start with this. I would say, despite the title of this, it is about freeing up your time. Okay. It is about lifestyle flexibility. It doesn't have to be about real estate syndications. That's about 80% of what I personally choose to invest in. But I'm just an advocate for passive income investments. I don't care if we're talking about hard money lending or ATM machines or car washes or mobile home parks or self-storage or multifamily, anything that's going to produce positive cash flow, passive income, and have potentially equity upside. So I want to start with that. And I want to start with 2009, which was a very scary time. And, much like this year, where in the news is all kinds of negativity, there's lots of volatility, the stock market's collapsing, this kind of stuff. And this is when I got into real estate. And there was this opportunity out in Fort Collins, Colorado. It was in a college town by Colorado State University. And, I found a townhome, and I knew a couple things about this purchase. I was a first-time home buyer. The government was offering an 8,000 credit to first-time home buyers. And I knew what I could do here is get a roommate in the second bedroom. I wasn't married, didn't have pets or kids or anything. So I thought, I'm going to rent that other bedroom out for $600 per month. I'm going to get a roommate. And these were my numbers. I knew my mortgage was about $641 a month. I knew I was getting handed a check every month at $600. So I knew I was effectively living for $41 per month. So
A house hack.
that's called a house hack. I didn't know that. That got the wheels turning, and I said, this is really cool, and this has a lot of power to it. How do I scale this up? I can't have 100 roommates, but how do I get $600 times 100? How do I keep rolling with it? So my initial strategy was pretty simple. It was work a W-2 job, which is what I was doing. It was save some money, and it was use that money to buy real estate and then rinse and repeat. It was kind of like you hear this a lot, buy one property a year for the next 10, 20 years, and there you go, you're retired. So that was how it started. And then I later created what I call the 4 pillars to financial independence. And this is what actually brought me to financial independence. It was earn as much as you can earn for a period of time using your highest and best. Some of us are doctor, lawyer, attorney, pilot, professional athlete, do your highest and best. For me, it was oil and gas work where I worked 100-hour work weeks, and I got well site bonuses and per diems, and I was in Saudi Arabia and blah, blah, blah. And then on the side, I was trying to scale up single family, flips and do all this kind of stuff. And that's a recipe for disaster. I don't recommend that. But that was what I saw as my highest and best earning potential, right? And then number 2 is live on as little of that as possible, that income that you're making, for a period of time. Not an advocate for just like penny pinch, use coupons, save everything you can, and one day you die with $10 million. That means nothing. That's not a good strategy in my book. But for a period of time to get you to financial independence, right? And so you're investing the difference. You're earning here, you're living here, we'll call it a 5 to 7 year period, and you're investing the savings into something that produces passive income. That's what I chose to do. Maybe some equity upside. And then avoid bad debt, buying financing the cars and the credit card debt and all that kind of stuff. Get rid of it is kind of my thing, if it's high interest debt. And really, those are the 4 steps. I mean, it's simple but not easy, but that's kind of been the formula that I've followed. And so I'll share with you this really quick, and it's why just having a high income isn't going to get you to financial independence. This picture of me back here, I don't know if you can see that, me in the oil field, that's me in Saudi Arabia, looking miserable because I was. And
I'm sorry, but I could not imagine you in an oil field.
Yeah, don't. It was not a good scene. So thankfully I made it to safety and I could quit, swinging hammers and, anyway.
Dangerous.
Yeah, it was dangerous work and not sustainable for me anyway. So I would basically wake up, go to work, come home and sleep, rinse and repeat, 14 hours a day, 14 days in a row. It was crazy kind of stuff. But there was a couple quotes that stood out during this time in my life, and they're actually both by Warren Buffett. And he says, if you don't find a way to make money in your sleep, then you'll work until you die. So it's kind of morbid, but it was really that eye opener that, yeah, you're right, and I'm going to die out here, essentially, is how I felt at the time. And then he says, never rely on a single income, create investments to create a second source. And I was totally subscribed to that, because oil and gas, as you guys probably know, is boom and bust. You could be making crazy money this year and next year you're unemployed, so it was something I started thinking serious about long term, as I need some backup plans here. So I burned out a single family, 6.5 years, tenants, termites, toilets, the typical story. It's fun and exciting, and then you get to that 6th, 7th deal and you're like, man, I don't know. For me anyway, it was hard to scale up.
I went through the same thing. Sold all my single families. Yeah.
I was just over at a Bigger Pockets conference last week in San Diego, and I heard this story, I'll bet you 9 times, throughout there. It's the same story. You get excited, you get the foot in the door, and then you end up kind of with a burnout scenario. So not everybody's story, certainly mine. And so those mentors shifted the focus to multifamily, right? I learned what a limited partner was. I learned that I could still get monthly income, tax advantages, equity upside. I didn't have to be a landlord. I didn't have to be the person doing all the work. And so invest for cash flow was kind of the name of the game. So I like to think of it like this. We all know what happened from 2008, 9, and 10, right? Great real estate recession specifically, right? Real estate, even though the stock market collapsed too. So this is how I like to look at that. Let's pretend I had invested in a multifamily value add Class B syndication in 2006, leading up to this meltdown. Put 100 grand in, got a conservative 6% a year cash flow, which probably at that time would have been actually a lot higher, but I like conservative examples. 5-year hold period, right? So $6,000 per year coming into my pocket in positive cash flow. You times it by a 5-year hold period, you got $30,000 pocketed from a syndication, regardless of price fluctuations. To me, that's what really stands out, right? The whole buy low, sell high can sometimes work in your favor and can sometimes really work against you. But this is why, to me, cash flow is king. If the renters pay the rent, the price can be secondary if you're not looking to just fix and flip and make a quick buck. You know, that's kind of how I look at it. So I'll pause here just because, you know, if you haven't, I'm going into presentation mode here, but I'll talk more about why kind of the value add strategy here in a second. If there's anything else you wanted to add to that, or.
No, how did you, you know, what you said you met that operator at a meetup.
Yeah.
But what is it that they said, or what is it that you followed up with them? Did you go observe them or ask to go to their projects, or how did you really kind of get into that? Because I get asked that a lot, you know, like how did you get all this real estate knowledge? I mean, I know you kind of messed around with the single families and things like that, but what did you do with that group?
So I always joke about this. I wish there was like a Yelp for syndicators, right? It's just like, oh, they're 5 out of 5, they're 1 out of 5. I'll go over here. But there's not.
Maybe we can create that.
Yeah, maybe we should do that. We'll do that after the show. But you know, it's a people business. Real estate's a people business. So it all comes down to networking. And who I actually met at that meetup was the limited partners. And then what came from that is asking questions like, well, who have you done deals with? Who do you invest with? What's your experience been? That's how I first started and found out about 3 to 4 operators. Then it came into bigger meetups and conferences and bigger pockets, forums, and this kind of stuff, where you start expanding your contacts. And all of a sudden I realized there's not 2 or 3 deals happening at one time nationwide. There's like 100. I'm just not in the loop, you know? Yeah. And now the problem's the opposite, right? I get sent 1,000 deals a year and I can only do reasonably like maybe 10 of them or something like that. Yeah. So it's unsubscribed business these days. But yeah, that's how it worked. And so to answer your question, the LPs were mentors, which is what I try to be for people today. For anybody looking to do this kind of stuff, they were free mentors. They didn't have programs and books and all this coaching. They were just like, hey, this is what we do. This is what it does. This has been our past performance. It is what it is. The operators, in terms of due diligence, you know, I think the biggest thing you can look at is track record. And, you know, do they specialize in a particular niche, or are they trying to be all over the place? Have they done this before? How successfully? Have they lost investor capital? If so, why? You're just trying to ask, you know, the basic stuff there. And the biggest thing I found to protect yourself is to diversify. And that's why I'm in, you know, 50 plus different LP deals, because you just can't know about everything on every deal.
Sure.
There's no perfect deal. There's no perfect operator. And, you know, thinking about like the scams and stuff of like the Bernie Madoff stuff, I hear that question a lot. I'm like, you know, the people who really got burned are the people that went way too hard and heavy. You know, they had a 10 million net worth, they put 8 million with them. Yeah, it hurts, right? Yep. But you put 100K with them, you made it, you know, so diversify.
And how did you find Ashcroft? What was that?
Ashcroft was probably my 3rd to 4th deal, and it was after Joe did his best ever conference in Colorado.
Okay.
Met up with them. It was exactly what I was looking for. I was starting to get serious about defining my criteria and my why, which we'll talk about a little bit. And it just met the markets. I mean, it just met the metrics. So the markets they were in, the deals they were doing, the value add component, the monthly distributions. There was a lot of things I was looking for, and it was just like check, 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 check. But again, I only did 1 deal. And I, you know, got to wait and see, right? Yep. Under promise, over deliver. I'll do a second deal with you. And so that led to probably doing 14, 15 deals with them over the years.
Wow. Okay. Yeah.
So,
that's great.
So I'll tell you this, which is something, you know, that really, the reason I love value add, the reason I love, you know, your deals at Spartan, and I love Ashcroft's deals, and I love anybody doing value add, If you take a 200 unit apartment building and you say the business plan is we're going to raise those rents $50 a month. Okay, and we got 200 units. Well, that's 120,000 in additional revenue per year if you can do that. And again, that's a very conservative example. We're raising rents hundreds and hundreds of dollars, but 50 a month, and that's a small unit. We usually buy 400 to 600 unit properties. So how much value is really added? So here's how you can do that. You can divide 120,000 in new income by the local cap rate. Sorry, there's the answer. By the local cap rate nationwide, and 2.4 million. It's simple math. I mean, it's just an example purposes only, but that's the valuation because the income went up 120K and someone's willing to pay a multiple for that income stream. And that is something you definitely can't do with a single family home. You could have the best tenant paying above market rents in the best neighborhood, blah, 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 blah. If your neighbor's got foreclosures, you lose money. No one cares about your renter. And so that was a big game changer in mindset. So to wrap up these, and then we'll get to your questions and any Q&A, I want to talk about the 8% rule. Being a full-time LP investor, I created this for myself years and years ago. 2015 and 16, if you were to be a limited partner in a syndication, it wasn't uncommon to get an 8, 9, 10% cash on cash return year one right out of the gate. That's just what was happening in the market. So I told myself, or I asked myself, if I go liquid, if I sell all these single family homes and I pay all these taxes and I start investing in these syndications, if I can conservatively get an 8% yield, then what does that mean in terms of income? So when your passive income exceeds your lifestyle expenses, your rent, your mortgage, your cell phone, your taxes, yada, yada, your healthcare, you're financially independent. So you say, all right, need $100,000 a year to live on. That's my goal. So you just run the math. 1.25 million invested with an 8% cash flow is 100 grand per year. So you can look at it. I created this chart. You could look at it. Okay, 8% is not doable in your opinion. Okay, well, 2%, 4%, 6%. You could go invest in bonds and you need what, 2.5 million invested. 10%. Maybe you think you can do more than that. Maybe you need less than $1 million invested. But this is the simple math to trying to figure out how you can effectively live off your passive income through your investments. And it's something definitely not taught, in schools, obviously, not taught by a lot of parents. It's just not a common topic. But to think about investing for monthly passive income and using that to either expand your lifestyle or to live on is just what my passion is and what I've done. So the levels to FI, meaning financial independence, are self-sufficiencies. You have a W-2 job or you're a contractor or whatever, you're kind of paycheck to paycheck, but you can at least support your bills and support yourself. This is kind of the first level to getting somewhere financially. Then stability is where, I can't even read this, you've eliminated some of your bad debt, right? This is kind of like the Dave Ramsey crowd. You're more comfortable. Maybe you got a little nest egg in the bank. You got 6 months of living expenses. Flexibilities where you've definitely paid down your debts. You've got a bigger nest egg. You could pivot careers if you wanted to. For example, you could take a sabbatical. You could take 6 months off. You just have more lifestyle flexibility. And then we move up to financial independence, which is what I teach, people how to do. And that's self-sufficiently living off your investment income as a lifestyle. And then there's levels above, which frankly, I'm not there, but
we all want to be there someday.
We all want to be there someday. Financial abundance is where money's not even part of the conversation, right? You think about like an Elon Musk, you can't even spend the money. You could be super charitable. You can get $1 billion away, blah, blah, blah. Most people turn to charity at this point because money's just not the motivator, right? You're not going to motivate someone like that with money. So here's what I want to leave you guys with. Defining your why for FI. So some people like you and I, we love to travel, some people want to be charitable. Some people just want to switch to part-time work. They love what they do full-time. They just wish they didn't have to work so much. Some people want to spend more time with family. So what is it for you? So I encourage you guys just to define what that is. I don't look at any deals. I don't look at any investments. Numbers mean nothing to me until I know what is it I'm actually trying to accomplish. And from there, I kind of reverse engineer. Susie over here that says 10,000 a month passive income is a lot different than John that says $5 million net worth as a nest egg by the time I retire. So you're going to look at completely different types of investments in those scenarios. So you got to know that. My dad's here, by the way, in the audience, and this is a picture of us right after he retired. So he worked for the post office over 30 years. And, we both kind of went about this approach through grinding it out. And, we didn't get to do a lot of trips early on that were bigger trips. Like we did a lot of local stuff and camping and stuff as I grew up. But this meant the world to me, that he was able to retire. And a lot of that had to do with syndications, because when you're a government employee, you've got a thrift savings plan, which is like a 401k, and you're looking at 2% bond yields, you're looking at 1% in the bank. I mean, you need millions and millions of dollars to retire comfortably.
Right.
And who has that as a postal worker of 30 years? You see what I'm saying? So as you move up to these 8, 9, 10% yields, and he's got a handful of single family homes and stuff like that, it was real estate that made the difference. And the point I'm trying to make is, again, passing away with 10, $20 million in the bank means nothing. I mean, to me, it means nothing, but it's what you convert your nest egg into that can mean trips like this, that can mean spending time with family, that can mean travel, that can mean being charitable. So something to think about, hugely impactful, part of my life story, part of my purpose and mission. So what I always say here is passive income allows you to do more of what you love and less of what you don't enjoy. From the simplicity of this, you hate mowing your yard, right? So you do a little 25K investment in a syndication. It gives you a couple hundred a month. Boom, you pay for a landscaping service. And if that's what you hate doing, there you go. So you can start, right? I should, but no, I'm still too cheap to do that. No, no, we do that in a lot of ways, actually, with our lifestyle. So for us, it's mainly travel based. And so, we want to take certain trips and do certain things. So we do a deal that gives us the cash flow to make that happen. So you can start in those beginning stages, just increasing and enhancing your lifestyle to the point where you can actually potentially live on income full time. So be an investor, not a landlord. I've got a website up here. I've got some giveaways on there. Obviously, we're here in person. Anyone watching virtually, I'm happy to do a one-on-one call, 15-minute call, no upsells. Don't have to talk about anything in particular, but anything I didn't cover in this short presentation, happy to do that there. So.
Well, thank you.
Yeah.
So I've got a few questions.
Let's do it.
More philosophical, more lifestyle, I think.
Okay, cool.
When's enough?
Yeah, how much is enough? No, it's so true. And it's funny. Got a guy in my network who retired at age 31 with $750,000 and has been retired ever since, happy, comfortably living the good life on his terms. I've also got an investor I spoke with last year that says, well, I own several businesses. I pull a modest salary. He said it's $600,000 a year. He said, I can't cut my budget. He said, I need $600K a year. That's my lifestyle. And that's the bottom line.
Yep.
So we're all different. I would just say, again, back to kind of the 8% rule, run the numbers, 1.25 million, 8% return, 100K a year. Just try to figure that out for yourself. There's some things we overspend on, and there's some things we're very frugal about.
Nice.
But at the end of the day, we live pretty humbly. So I don't need a lot.
And I was just going to say, if anybody has any questions on the Zoom, feel free to put them in the chat, and I'll get them sent over to me here as we go along. What would you say, what's your expectations this year for returns? Now that we've got rising interest rates, we have rising asset values that seem to not be cracking quite yet.
Yep.
As an LP, what's your expectation?
Yeah, it's a good point. As we talk about things like the 8% rule, and as we know, markets are always evolving. I always joke that, and it might become true, that, if interest rates kept going up to where a 2-year US Treasury bond is yielding me 8% and a syndication's yielding me 4%, guess what I start investing in, right?
Yep.
And so you have to be opportunistic in that way. Generally, I'm not a fan of the stock market, but when the stock market's 40, 50% down on some REITs and they haven't cut dividends, the yields can be attractive, you know.
Sure.
But in most cases, the reason I don't like the stock market is the volatility, the ups and downs and the unpredictable, and it's out of your hands. We could be doing our business plan, Spartan and Ashcroft, perfectly, executing, over delivering. And guess what? If the S&P and Dow are down, we're probably losing investor capital too, right? Our shares are
Exactly.
down.
Yep.
And that's the biggest drawback. So what I would say is this: realize that when you're doing value add, there's a potential to raise revenues and rents. And so just because a year one could be a 5-6%, you could quickly get back to 7, 8, 9, 10 over time. So when I look at my portfolio, I've got things cash flowing, some of the older deals I'm in at 12, 13, 14, 15% annualized cash flow, and new deals at 5 and 6. I'm still able to capture that 8%,
On the average.
threshold on
Right.
the average.
Correct.
So keep that in mind. It's not like every dollar of your net worth goes into a brand new deal today. Unless
Sure.
you're just getting started and doing that, I suppose. But that's something that's unique about this year. Is you're right. So interest rates come up, right? That hurts potential sale price, but we're doing value add real estate and we're able to raise rents on self-storage or raise, apartment rents. And that's adding millions of dollars back to the property.
Sure.
So you're getting hit and then you're coming up and then you're getting hit and then you're coming up. We're in like an equilibrium. Bet on the jockey, not on the horse. I mean, that's how I look at syndications.
Absolutely. What's the perfect deal for you? If you could predict exactly how it would go for maybe it's a 5-year hold, a 10-year hold, maybe it's a evergreen hold.
Yeah.
What would be your most ideal investment?
So another reason I like value add, despite what I showed here on the presentation, is it leaves you a margin. So if we look back at the Great Recession, we look at statistics, your average B class multifamily rents fell about $125 per month at the absolute worst and bottoming out of that market. Most deals that we're buying today are already $250 below market rent. If we're able to just get halfway through our business plan, we've got enough margin to, technically or theoretically sustain a downturn like that. So that's why I like the value add versus, say, the new development. So to answer your question, it would be real estate for the tax reasons, for the leverage reasons. It would be in a Sun Belt market. It would pay me monthly distributions, and every year it would be kicking up about 1 to 2 percentage points, give or take. It would have equity upside on the back end when we sell, and I'd be able to cash out or 1031 on the back end. And you put all that together, and that's a powerful product. When you look at other, annuities or whole life insurance or bonds or CDs, like they just don't offer all the elements.
Sure.
And I did some time working at a huge brokerage firm, one of the biggest in the world. And I'll tell you, I went right back to real estate. It took less than a year. I got my foot in the door. I got licensed. I learned. I said, it doesn't make any sense. For me personally, I'm not saying there's not a time and place for some of those products, but real estate's kind of got a lot of great key metrics to it.
Sure. Let's talk about asset allocation, if you don't mind sharing as a percentage.
Yeah.
What's Travis Watts's portfolio?
Yeah. So my philosophy is that you want to invest the majority in things that you know and understand the best, to take as little risk as possible, to have the best chances of a better performance. For me, it's always a real estate allocation. And for me personally, it's the majority of my money's in multifamily value add. But the reason I'm in Spartan is because, I take at least 20, and these days probably more like 30%, and I allocate towards mobile home parks and car washes and note lending funds and the public equity markets and other things, to diversify and to learn. And if I ever have to make that pivot to be in that US Treasury bond investor, I know something about it. It's not a foreign concept. I can say I've been doing that for about 5 years on the side. So invest in what you know and understand is the lesson. I think the one time I lost money, big money, real big money, it was in a private placement that was non-real estate that I didn't fully understand, that ended up kind of being a partial Ponzi. And so we all lost a ton of money. And,
Bummer.
In hindsight, I just didn't understand what I was doing. And I did it for diversification, but I went too hard and heavy on projections and not on just fundamental common sense basics.
Outside of storage and multifamily, what's your favorite asset to invest in the real estate part of things, or anything really?
Yeah. Wow, that's a good question. I love when a perfectly fine company is beat to the ground in the public equity market. I mean, I hate that happened, but I love the opportunity to get in and scoop it up.
That's a good point.
And then you've got, again, the equity upside potential, no guarantees.
Yep.
You've got monthly distributions, because that's all I invest in is monthly distributions. And so it's the same kind of play and philosophy. You're just switching over to that. It could be a REIT, it could be a company, it could be whatever, but usually they're REITs. So.
Well, great. We have a couple seconds here for questions from the audience. Does anybody have any questions want to ask? Yep. Jared?
One that I've struggled with, I have a healthy investor. How do you 1031 exchange on the back end?
Yeah. So
Yeah.
the question is, I'll repeat it just for the
Thank you.
video. The question is, if you're a 1031 investor, how do you, or your LP investor, how do you 1031 to the next investment?
Yeah, it's a good question. So not every operator is going to offer the ability to 1031 exchange. I think you guys do at Spartan, we do at Ashcroft. So we facilitate, if you want to exit a deal. So say we have a fund this year with 5 properties in it, even though we have 7, I'll use some simple math. You put 100 grand in the fund, that means 20K per property, just for some rough math. 3 years down the road, we sell these 2 properties, right? So now you have an option to 1031 to another Ashcroft opportunity. So that's 40,000 plus any equity upside, or cash out and pay the long-term capital gains, depreciation recapture, whatever. That's your choice. Doesn't need to be a majority vote. You go with Ashcroft in another deal. We facilitate and pay for it. You want a 1031 on your own, you can, but it's on you. You got to use a third party and do your thing. Personally, I don't do 1031s in the syndication space, but a lot of investors do. So that's up to you. So first, you need to find an operator that offers it. Second, it's usually their own deal that's going to be easiest and most common sense. And then, but just know that you could do it on your own. It's just more complicated. And yeah, I won't get too deep into it, but a lot of people love that option, and I'm just not someone that does it.
So I invested in an Ashcroft multifamily deal. They did a 1031 exchange, and from an LP perspective, it was the most seamless process I've ever been through. It was like, do you want to do this? Yes. It was like, sign these 3 pieces of paper. Yes, yes, yes. And then all of a sudden it just happened. So hats off to Ashcroft for making it very, very simple. I'm sure there was a lot of things going on in the background, though.
Oh yeah.
So, I have a question from the Zoom chat. Hi, Travis. Good to see you. When you're watching a presentation for multifamily or self-storage syndication, what are some red flags in terms of adjustable rates, terms expiring, no cap rate, cash reserve, bridge loan, et cetera?
Great questions, man. This is a huge conversation. So I can only share from my personal perspective. I can't give anyone advice or tell you what to do, but some things I look for is I love monthly distributions. To me, it lessens the risk. If I'm getting paid out monthly, I'm getting more money back in my pocket. If anything were to happen, I at least had that much more money in my pocket versus a new development deal that may not pay out for 5 years. That's one thing. I like preferred returns, which is not a promise or guarantee, but it just means the investors are getting paid before the general partner. And it's the next best thing to a promise or guarantee that nobody can make. I look at track record. Like I said, does this group specialize in what it is they're offering, or is this the first time they're experimenting with something new? That's important to me. Just general track record. Like I said before, have any deals gone south? Have they had an investor capital call? There's just some questions you might want to ask, and know about. And it's not to say if they've had a deal go south, I wouldn't do it. It's just a question to ask. Sometimes, to those points, student deals, I don't always do. I've done probably 3 or 4 of them. Some have worked out really. In fact, one just
Can you
sold.
clarify that? Student?
Yeah. So if you've got a group of students that, you're in some program where they're training students to underwrite, do acquisitions and asset management, I'm not opposed to it. I'm just saying, generally, I don't do deals like that. I've had some go not so great at all, and I've had others kind of outperform, but I just generally don't. So not bashing any kind of programs in the industry, just a personal preference. What else can I tell you? You want to get along with these people. I test them by, I'll call on a Saturday and I'll see if anyone picks up. I'll send an email on a Sunday. I'll see if anyone responds. And I'm not looking for an immediate response. I'm being reasonable. I know it's the weekend, but what I don't want is next Thursday, someone goes, oh, sorry, blah, 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 excuse. You're going to be in communication for years with people. To me, communication's key. And so that's something I look for as well. So I'll cut it there on just a few things to look for.
Oh, got one more question here from the Zoom chat. Thank you, Roy. what do you not like about 1031s and syndications?
Yeah. So I'm a younger guy. And so I think about if I'm going to get on that conveyor belt of 1031s, I got a long way to go until the ultimate strategy, I guess, would be that you pass away and that you've 1031 your whole life and that you've avoided the taxes. And now whoever inherits that portfolio gets the step up basis, right? There could be political changes along the way. In the syndication space, you have less flexibility than if you were to do your own single family homes. There's less of a pool to choose from. Let's say I do it once with an operator, love the deal I 1031 into. I do it twice. I love the deal. The third deal, I don't like it. I don't like that deal. Well, I'm kind of stuck. Again, I can do it on my own. It's just going to be a lot of legwork. The last thing I want to have is a $100,000 tax bill land on my lap that I didn't expect to have. And that's pretty much the reason. I'd be in a different spot if I were 65 years old. I would think a lot differently about that, or maybe if I were part of the team,
Sure.
that was doing the 1031s, I would have a little more control and insight to it. But
I like that conveyor belt. It's a long conveyor belt. That's a
It
good,
really
that's a
is.
good description of that. It's going to take a long time. Well,
Yeah.
let's hope it at least.
yeah.
What other operators does Ashcroft Capital respect or admire in the same sectors or other sectors?
Oh,
If you're willing to share.
yeah.
This is not an investment advice.
right.
Do your own due diligence.
Yeah. So I would put it this way, there's an ecosystem that exists. There's people that kind of mimic the model of what Ashcroft's doing. I'm not going to name the names, but they're Sunbelt investors usually. They're monthly distributions. They're Class A, Class B shares, which is usually means the Class A has a higher cash flow amount, but no equity upside. And the Class B kind of does a hybrid share, a little less cash flow, but you do get the equity upside, that kind of model. And multifamily or any other asset. So they definitely exist. I'd say let's chat offline. I don't want to drop any names here publicly. So.
We tried.
Yeah.
All right. Room for one more question. If anybody has anything from the audience, otherwise we'll wrap it up. Go ahead, Drew.
With Ashcroft right now, what's the biggest challenge? Is it finding deals? Is it finding equity? Is it operating the environment? What's the thing that you spend the most energy pushing on?
And just for the sake of the recording, what is the biggest challenges that Ashcroft face today?
We're at an interesting point where the Fed has increased rates so rapidly, so quickly. The market hasn't really had a chance to adapt fully. Okay. Because in private real estate, it's like, imagine steering a cruise ship, you start turning that dial, but it's going to take quite a while before you start seeing those results. Unlike the public market, that's like, jumping off, the beat of your knee there. So I would say this: sellers right now are hesitant to start price dropping rapidly, right? Even though interest rates have come up, and that means higher borrowing costs for the potential buyer. So less transactions are occurring from my point of view. I would say roughly half of what I saw last year, for example purposes. So a buyer going in has to factor the new loan and the new debt structure, and they have to say, look, this has to be the price because this is our carry cost, but the sellers are not quite swallowing the pill. So I would say it's transactions and finding enough transactions, that are going to occur, or enough deals that pencil out right now. So.
And that's a really great transition. We're actually going to go ahead and start the state of multifamily discussion. And I think that's going to be one of the key themes today.
Cool.
So with that, we're going to go ahead and call up Jared and Dylan from Kidder Matthews as well to join us. Never done a transition like this, so hopefully it goes
I'll
okay.
sit on the south side.
The hot
You're going to
seat,
sit out
hot
here?
seat.
Okay. All right. You guys.
So let's do a quick audio check just to make sure everybody's good. Okay, great. Well, thank you for joining. Thank you for coming in. And what we're going to do is we're just going to talk about the state of multifamily. Before we do that, why don't you go ahead and just introduce yourself? Tell us about what you guys do and in the market.
Absolutely. I'm Jared Anderson. My partner Dylan Simon and I run a commercial real estate brokerage team. We work at Kidder Matthews. Our team's called the Simon Anderson team, and we specialize in selling apartment buildings and development land for apartment buildings. It used to be throughout the Puget Sound. We've also expanded into Eastern Washington.
Oh, okay, great.
Jared pretty much said it all. I'd say the breadth of what we do, I'd say that so far this year, the smallest transaction we've done was 645,000, and the largest was a touch under 105 million. So we cover the scope from private investors that might buy a duplex or a triplex up to institutional transactions, several hundred units.
Last year, what did you guys transact as a brokerage? About how much AUM?
With Kidder Matthews, I'm not sure. I don't track them as much, but our team, we did just under 50 transactions.
Wow.
And probably about 500 million.
That's great. And in 2022, are you tracking the same amount of transactions as you did last year, or are things kind of slowing down or speeding up even?
We actually had a really fast leap at the very beginning.
Really?
So if you watch racing like a whole shot, we just flew out of the chutes. And so I think at the midpoint in the year, we had closed just under 40 transactions already.
Wow.
And now we're sitting like at 46. Let's slow down a little bit.
Wow. And what do you attribute the slowdown to?
The Federal Reserve has different plans for transactions and investors right now.
And that's one. And then the other on the equity side that you had mentioned is our clients, a lot of their money is sitting, waiting in the wings in the stock market. Well, if it's down 30%, you don't want to sell that and buy real estate right now. So it's a little bit tied up.
Yeah, that's a good point. Wasn't, by the way, Q1 this year, wasn't it like 56% higher transaction volume than we've seen in like X amount of years? It was like a crazy Q1.
It was probably even
Nationwide.
greater within this region.
Yeah.
'Cause we took a little bit longer to recover than maybe the Sun Belt did. But
Yeah.
do you have a stat on that?
Yeah, I mean, it wouldn't surprise me if it was up 100%, but that
Yeah.
50 something seems right. I mean, just to give a frame of reference, most real estate debt, so if you're going to get a loan, is based off the 10-year treasury. So December last year, the 10-year treasury was about 1.5%. As of today, it's about 3.8%.
Yeah.
So just the cost of borrowing, it hasn't translated exactly, but it's nearly doubled. So when we're looking at these returns and you're looking at trying to get it, we talk about cap rates a lot. Well, cap rate's an unlevered return. So if someone's trying to sell a transaction, we were selling a lot of 4% cap rate deals. So it was a 4% return. Your cost of capital right now could be 5.5 or 6%.
Right.
So it's completely upside down. So it's really just the market's kind of stuck right now until we decrease this bid-ask spread that you've been talking about, Travis, between where buyers are and where sellers are, and they haven't quite figured out where they can agree on price.
That's a great point. Even in the single family space. So, we had locked in at like 2.75 last September. Now interest rates are ballpark of 6, but our homes have hardly discounted, right? So it's that hesitation again that it's got to play out.
So when you say your homes, are you talking rents?
No, I'm sorry. So our owner occupied house, single family home that we bought, that was our mortgage rate, 2.75. Now we're
Gotcha.
upwards of 6,
Yeah.
but that price point has hardly adjusted.
Understood.
So people are kind of biting the bullet temporarily, but what needs to happen is a price adjustment.
And markets rise fast, but they fall slowly. And so, especially in real estate, as Travis was saying, these aren't really liquid transactions. You buy an apartment building, you've got generally, and I think not everyone realizes apartment, commercial loans are generally 5 to 7 year loans. It's not like a single family house where you've got a 30-year mortgage. So investors generally have a thesis of 5 to 7 years of ownership. Now there's different products to go longer, but in average, it's that long. So if someone bought a building last year, they plan to hold it for another 5 or 6 years. So they're not super liquid. So right now we are seeing some people caught at their end of that life cycle and they're having to sell.
Right.
Because they may be upside down. So transactions are still happening, but we saw this happen as soon as COVID hit back in 2020. It was a complete holdup in the market. But 12 months later, by spring of 2021, the market bounced right back. And so I think people are trying to figure out where the market's going to reset, and they're holding on to dry powder. They're not quite ready to spend that dollar, knowing that the sellers haven't come down in price yet.
What deals are the most popular right now in the market that are trading, that are selling, and what deals are kind of the least popular right now? And we can speak Puget Sound or Eastern Washington, just kind of in general from your perspective.
I would say still what I'll call some hangover from the pandemic. A Seattle address has been tough. I'd say there's a few things that push the tides away from Seattle and some would say towards Bellevue. And we feel it's kind of a Twin City aspect. But yeah, Seattle address, especially as it relates to legislation and some rent control concerns has been a tough one.
Tough sell.
And then most exciting from my perspective is still the suburban value add. It's pretty straight over tackle, been in demand for quite some time during the pandemic, and market by market, but I'd say the larger the better. The people with the more money, I feel, have comfortability in this moment of chaos. And I've said for a little while, small money, scared money. And so it's just, if it's your first time, it's hard to do it when everything you're hearing in the news is pretty negative.
And what about on the Ashcroft side? Are there particular markets that are, that you have a preference for, or that are just easier to transact in?
We've been doing the majority of the markets in this fund this year that we've done is Atlanta and Central Florida, but we miss out on a lot of deals. I mean, we're trying for like everybody is, but to your point, I love what you said, because you think about new development, you're getting hit on two sides, right? You've got a higher hold cost to consider. And as interest rates keep ticking up, you have a lower potential sales price on the back end, and then you have no cash flow and no ability to raise rents in the meantime. With value add, it's still a very popular asset class for that reason. We're seeing 8+% annualized inflation. That gives you a good thesis here to be able to lift rents in addition to the traditional value add plans. So I still think there's a very bullish case, personally speaking, in that kind of sector. Which is probably why it's very popular. And then we just sold a handful of our properties to Goldman Sachs in conjunction with some other groups. So what's big money doing in recession? Something to look at.
Yeah. And if you look at previous recessionary periods, it was eds and meds. So investors went into education and they went into medicine. So we've heard this last time since COVID, it's beds and sheds, meaning they're going into apartment buildings and mini storage and light industrial. These are type of things that really have been resilient, because if you look at Amazon warehousing, people need warehouses. They need warehouses to put things, a lot of online shopping, mini storage. People are staying in apartments. They're not moving around. They're not buying bigger houses and moving into houses. So this beds and sheds concept is stuck with us. I tell you, folks on the retail side are having it really tough. Selling a retail building, selling an office building is really tough right now. And so, but the flip side of that, there's more capital chasing the apartment deals. And so that's been the real challenge right now, is you have a lot of money and you don't really want to do a bad deal. But there's a saying is bad deals are done in good times and good deals are done in bad times. So Jared and I also invest as well, and we syndicate. And some people think these are bad times to invest in multifamily. You may not have to pay rent. There may be issues with municipalities not enforcing different rules, and people have shied away from different areas. That's where we see smart investors rushing in. And we've seen some price dislocations, Seattle, Portland, the west side of LA, because investors are shying away from these markets and they've gone to the Sunbelt markets. They've been really popular. But Phoenix has had 10 to 15% rent growth year over year for 3 or 4 years. It's just not sustainable.
Yeah. And I'm a dollar cost average kind of guy. I think most people that subscribe to a particular type of investment, whether it be stock market or syndication. So like the last deal we just purchased was at about a 9% discount, from just a few months ago. And so I'll take it. You know what I mean? Like it's the purchase prices are being affected, but we're still got a good value add case to bump the rents. And so just like if I was long-term in the S&P and it dipped 9%, I'm a buyer. That's how I'm not going to say, well, I fell 9. I think it might fell 65. So I'm going to sit here for the next year and wait and see. I don't subscribe to that. So.
I just have a comment on that with the 9% discount. One thing I've been talking about with a few owners, I'd love to sell it. I want to be that person that, missed the top. I'm like, well, everyone misses the top. But I think values, we're beating our BOV, so our broker opinion of values, by about 10% for a 9-month period from the end of last year, September, to about June of this year. And now we're 10% below that. So I think we've actually hit like a market pricing now with this 10% discount. Feels like some of the cream might have come off the top. I'm just saying this for sellers that are feeling that, uneasiness about pulling the trigger. I think you're still doing very well.
Oh, absolutely. I mean, you see the top of the market in Seattle and the residential, it's like we had this massive peak, in March.
Yeah.
And then we just kind of cut that peak off,
But we haven't gone necessarily down in quite some time.
Yeah.
Right.
So let's talk about that a little bit. Residential pricing is getting more expensive to buy a house. You're not getting as much house because the interest rate is higher. And so that's sort of keeping sellers maybe from listing at the wrong at this time because they're maybe not going to get the best price. And maybe it's keeping my theory is that maybe tenants are staying in apartments for longer, which is creating more of a demand for apartments. Couple that with the fact that builders might not be building as many homes now because costs are higher, supply is higher, construction labor is up, supply chain disruptions. Are you guys seeing a push of more rents because of that?
Well, I think it's super bullish. I mean, first of all, our business plans, like I said, we're usually lifting rents, say 250 over a course of 3 to 5 years. So if I'm a renter today or last year, let's say, and I signed my lease and now my rent goes up 100 a month, which is a big steep increase, right? But how much would my mortgage have gone up, doubling interest rates, right? From 1,400 a month to what, 2,300 a month? I'm still a renter, you know, and I think we're seeing more people get priced out and priced. They were already getting priced out.
Sure.
Now you double and you're not seeing the cuts like we talked about that
Yeah.
are probably needed.
Mhm.
And so I think it's very bullish and our occupancy's up, you know, 95% plus in a lot of our communities. And so that's my
That's great.
take.
Are you guys seeing the same thing?
Yeah, I mean, especially in the Puget Sound, the barriers to home ownership are just huge. And now that interest rates have gone up, and I expect they'll stay up for the foreseeable future, those barriers are high. And we also live in a very transient economy here. There's a lot of people going in, especially in tech, that don't want to buy a home. So that's another aspect is we just don't have what we call this shadow market of single family homes where someone's going to go and not be a renter and buy a home when the average home price is $600,000 to $900,000 in this region. So I think that's why so many people are bullish on multifamily right now. As you look at the long-term dynamics, one, the age of rentership, it used to be 20 years old to 28 or 30. Now it's pushing to 40 years old, especially in markets where people get secondary education. So you've got more renters, they have more disposable income, and the fact is they can't afford a home. And so, I mean, you look at all the other aspects or different product types of investing. Again, office looks a little bit scary, retail looks a little bit scary. So there's a lot of investors in multifamily. So we feel really bullish about it. And to Jared's point, pricing wise, I just got off the phone literally before stepping up here with a client that had a building on the market and wasn't sure he's going to sell. And he finally looked at the numbers and said, yeah, it wasn't as high as if I had sold last year, but I'm still absolutely way higher than I thought I'd be at this point in time. So they're very reasonable about where value is versus this sort of loss aversion. People hate losing that value they thought they had, but in effect, if you've owned for more than 3 or 4 years in this market, we've had good 5, 7, 10% appreciation every year for a number of years that owners are still doing quite well. And I guess the last point is the big barrier to entry. The cost to build a new apartment building is so prohibitively high, especially in this market, that you really have, if you can, you know, if you're dollar cost averaging and you're buying a building at rates right now, you probably can't build a building for that price.
Yeah, you certainly can't charge, you know, $1,300 a month in rent. You know,
Yeah, absolutely.
Which is, you know, what we're targeting. And I love what you said. Another thing I'll tag on is that I think if we look back at history and who was a renter versus a homeowner when the differentials were a lot, you know, more consistent and like kind. My wife and I chose to rent for many years here in recent years and invest instead. And I think if you guys haven't toured some of these B+ quality assets, I mean, you have pools, you have gyms, you have barbecue areas and pet parks and resident events and free catering and food and social. I mean, it's cool. I mean, it's really cool. And that's the kind of product type that we're in. You know, we're buying kind of the B+, A- stuff. And I think there's a lot of baby boomers that are also, you know, it's a hands-off kind of lifestyle.
Sounds really nice, actually.
Yeah.
One of the last buildings I sold, I was taking pictures to show my wife that one day maybe we can live in a place of this nice. Yeah, I'd say the dog bath was better than my bath at home. It was, and you don't have to clean it.
Yeah, that's great. So Travis, and I'll ask the same of Jared and Dylan. What index of interest rate are you basing a property like that on? Is it SOFR? Is it prime? Is it what's the typical, and what are you getting right now on an asset like that?
Yeah, so we just closed our last deal. So if we're doing a smaller project, say it's a 200 unit and it's half renovated already, we're probably going to turn that around rather quick. We're going to use private debt. We'll do SOFR plus, you know, I don't know, a couple points. We'll buy an interest rate cap, you know, to make sure that we're covered on that end. If it's going to be a 600 unit that's been untouched for 20 years, That's gonna take us years to go through. We're gonna do a Fannie and Freddie kind of loan, fixed rate for, to your point earlier, or your point, 5-7 year kind of debt
Mhm.
term, something like that.
Yeah.
So,
And on that, the SOFR rate today, what was that? Is that a lot different? I mean, is the added points a lot more than last year right now, or
Oh,
is it
yeah.
staying the same? Yeah,
Yeah.
okay. I mean, the effective rate's gonna be higher, but are they benchmarking higher off that kind of floor rate?
Yeah, I wish we had our acquisitions guy.
Yeah, I know, I'm getting technical.
Well, I mean, I'll say spreads that we're seeing is we were seeing quotes over SOFR at 200 over to 250. Now we're not seeing anything a touch below 350.
Wow.
So, I
I mean, if you
mean,
consider your effective rate is gonna be that much higher as well. I mean,
well,
that's-
and
that's incredible.
it's also just they're building in the volatility in the market. They just don't know how much more the Fed's going to move rates each time. And we still have 2 more rate increases this year alone.
Right.
So that, I mean, that's the problem with non-fixed rate debt right now. Is it's really challenging. And in rate caps there's a lot of people in the last 2 years that are kicking themselves for not buying rate caps.
Yep.
And I think that's where people are in trouble right now is people with floating rate debt.
Well, rate caps have gone up in cost, have they?
Supply and demand. Everyone wants them now.
It's kind of like insurance in a hurricane.
Yeah, absolutely.
Yeah, yeah, it's a little bit more expensive these days. What about seller financing? It seems like in this market, a way to win is to get the seller to carry back the note, especially with interest rates going on. They want their price, but you can meet their price maybe if they hold back paper. Are you seeing a lot more seller financing transactions in the market?
I can speak to that. My niche where I spend most of my time is probably 5 to 25 million, primarily working with private owners. And
Sure.
I think they have the ability to offer that. So I can tell you that it's just been absolutely off the table for so long, and now we're working on 2 of them.
Really?
So it's
Just in the
like
last couple weeks.
in the last maybe 60 days. It's
Wow.
just like, here's all the offers on the table. You wanted 10% more, and I understand that. It's no longer there. How do I get there? You either wait for an unknown amount of time, or maybe we'll offer someone a better rate. And so then they come back and say, well, who would be interested in that? And then we go to the top bidders and see if we can structure a deal.
You don't have to talk specifically about that deal, but what are you seeing on some rate and terms for the seller?
I think the buyers so far, because I know that this has been a product that hasn't existed for my career, so about a decade,
Yeah.
right, are asking for what I think is reasonable. So maybe minimum points to take the money out and give it back, and around 5%. And if they
Okay.
start there, it feels pretty comfortable.
Interest only?
Interest only usually for the stabilization period, and then potentially shifting to amortization. The biggest difference I'll say I see from proposed terms on seller financing from the seller's perspective as opposed to a bank, they really don't want these longer term loans. So 10 years
Right,
seems like it's off the
right.
table, even
Yep.
7, it's usually 3 to 5
3
years.
to 5 years.
Yeah.
That's great. And what about assumable notes? Multifamily, it seems like a big advantage of multifamily is that you guys have assumable notes.
Yeah.
Are you seeing buyers sort of over equitize a property to take advantage of the assumable note that's in there at a much lower interest rate?
Well, it's not even over equitizing because when the market was really hot, a lot of these investors were going in and they were getting only about 65% leverage.
Wow.
So what's interesting is, I mean, this has become a very in vogue topic is all these loan assumptions. There was a time where you couldn't get enough debt. But the last several we looked at, we were within 2 or 3% of debt off. So like
Interesting.
because asset values rose so much, they've fallen a bit. So it's somewhat equalized now. That's not always the case, but if debt was placed in the last 2 or 3 years, usually we're getting somewhere in the mid 60s to low 60s in debt. And for these commercial loans, generally, at least in this region, we've seen them sort of sized somewhere between 55 to 65% debt, just because we've got a pretty low cap rate environment here. So that's, I mean, I would say a year ago, I was working on 0 deals that were loan assumptions. I'd say it's coming up, and what we're selling right now, if someone calls up our office and they've got in-place debt sub 4.5, we think that deal can get done.
Wow.
And the challenge is sellers want 4 to 4.5 cap deals.
Sure.
Well, when debt's at 5.25 to 5.75 to 6, it's just they're impossible to get done. I literally yesterday morning, I got a call from a client looking at a property, and the debt on the property was 287. And that seller wanted a 4 cap. He said, but we're in a 5 cap market. Should I do it? I said, does it cash flow? And he said, yeah. And I said, how long is the debt? He's like, 8 years. I said, you should be fine. And so that seller is going to get paid a pretty handsome price compared to market pricing right now
Mhm.
on that fact alone.
Wow.
And so it really is, it's a tale of two cities. I mean, it's just like if you've got good debt in place and it's assumable and you've got some term on it, I'd say at least 3+ years, that absolutely plays in this market.
That's great.
And don't every seller fall off your chair right now and get excited. The biggest challenge is the LTV can be too low. So
Right.
if your LTV is 50% or less, there's a very slim pool of buyers for that.
Right, because they have to bring so much cash to the table, and that was
Like
my
you-
point
like you
about
said,
that.
yeah.
Yeah. So, yeah. But it still might be worth it, because if you're an LP investor looking at an opportunity and there's assumable debt at a low interest rate,
Right.
and yeah, you have to bring more equity to the fight, but now you have kind of less risk because you have less debt on that investment.
Exactly.
So it could be a possible great investment, but just a lower maybe yield or lower cash flow, maybe a lower multiple because you have more equity into the project.
Well, it all goes back to Travis's point, it's cash flow. I
Yeah.
mean, if they can get the cash flow out of the deal, and one of my favorite sayings, Jared's heard me say this probably too many times, but I heard a couple years back that I think is now coming back into vogue, is you can't eat IRR. And what you mean by that is you can't buy groceries with IRR, but with cash flow you can. And I think we've shifted back to investors primarily looking at cash flow. And I won't name them right now, but there's a certain sponsor out there that takes LP dollars, and I've been watching their materials come over, all their solicitations. And this has been for the last 3 or 4 years. And about the last 60 days in their deal metrics, they always showed equity multiple, IRR, and cash on cash. For the last 60 days, they just stopped reporting that cash on cash line because it's nearly non-existent.
Yeah.
Because they're betting on they're betting on this big exit. And so I'd say for those of you looking to invest in LPs, or LPs looking to invest in sponsors, that's one of the big things you should be looking at is, yeah, if they've got a great IRR, that's terrific, but what if they can't have that exit? Can they hold on? Do they have bridge financing, which is short term? Can they survive what we'll be going through for the next 12 to 18 months?
Exactly. Let's talk about deals that were put under contract maybe 3 to 5 months ago that still haven't closed. Let's talk about renegotiation or price adjustments. Are you guys seeing that happen more frequently now as opposed to last year? Or are you seeing kind of pricing readjustment now that maybe a buyer gets something tied up and then the interest rates change and the terms changed and the leverage goes down? So now they're going back to the seller and asking for a renegotiation. Are you seeing that?
You've been reading our diaries, haven't you? Jared, you want to give the war stories first?
Oh man, it's been a bit of a battle. I would say the one thing I'm thankful for is the buyers have felt very judicious with their offers. And what I mean by that, I've been guiding to 15 million on this, listed asset that doesn't have a price. Instead of people coming in at 15, knowing they're going to come back and retrade us because the Fed's moved the rate and everyone knew they're going to move the rate.
Right.
They're just coming in at 14. Right. So we actually haven't had as many issues as I would have anticipated with people bidding too high with kind of this future retrade in mind. But maybe we've just been really fortunate with where our deals lined up in relation to the debt markets. So that hasn't been the major issue. It's really just been sellers' expectations.
Yeah, that's great.
Q2 was a bloodbath. Like deals got under contract in Q1. I mean, in February of this year, the 10-year treasury is 1.87. And by May, it was over 3. It was about 3.5. So during that transitory period, it was a big challenge, and we were seeing major changes in what debt you could get. And then once buyers knew that was, the Fed funds rate was running, then they started to recalibrate. And I was impressed, to Jared's point, buyers are being really judicious. We've seen rates go up 10 basis points every single week for the last 6 weeks. We've got to price that in our offer. And so sellers looked at these offers and they said, why are they so anemic? And it was buyers are forecasting what's going to happen. So the market's level set a bit. The challenge is we've got 2 Fed rate hikes left this year.
November, December.
Yeah. So now, I think there is a hold pattern right now, but I would say if you're a buyer out there, there are some good deals getting done out there. There are certain sellers that say, look, I'm going to make plenty of money. I do want to sell, or there's some forcing function to sell. So we happen to think now is the best time to be making offers on buildings, because you could be the last buyer standing and you could have a real seller. So I'm a big fan of investing in market pullbacks.
So let's pull on that a little bit. I like that. So let's say you don't have all cash and you've got to rely on debt. How do you survive right now when a term sheet is effectively worthless?
Well, I would
Even more worthless than it was in the past.
Yeah. Well, I would say this is where you lean on lending relationships.
Sure.
Is certain banks, who's going to be around in 5 years? These banks want good customers. And you go to your bank, and if you're loyal, I mean, several deals we've got done this year, they've been bank loans versus Freddie Fannie loans, and it's been with good borrowers. They've gone to their bank and said a differentiating factor of this is, can you agree to this term sheet? I've had groups sign term sheets before they submitted offers.
Wow.
Just they do their underwriting up front, they get a term sheet up front, and then they move through their due diligence and get rate locks quickly. So that's one strategy. We've looked at others where we've got seller financing. So, that's known day one. You negotiate that with the purchase and sale agreement. So that's a great strategy right there, because that takes that probably 60 days of uncertainty away, because you've negotiated at day one of what your debt structure is going to look like.
Yeah. Yeah.
So there's a couple, it's difficult. I mean, Jared and I in what we're buying right now, we're generally not submitting offers till we have a term sheet.
Yeah.
And like you said, they could get torn up or go missing. What I've found with clients, just looking at all the deals we're working right now, it feels like the smaller institutions, the credit unions, are less concerned with how the metrics that they're basing their interest rates off of move, and more basing it on the relationship. So I know that means generally smaller deals, but they truly are looking to establish a relationship with someone that's going to work with them through the next few years. So I've seen, and the larger you go, right, they're just like, hey, we could just spend this money for more return. We'll just tear that up and do it with someone else. So if you are thinking of getting into investing or have ran into some challenges, I found going with some of the smaller lenders can be pretty helpful.
When you say smaller lenders, right? Local credit unions, bank next door.
Yep.
Yeah.
Exactly. I'm talking it's available. It's not completely private, but it's also not Fannie and Freddie.
So I've heard maybe the way that we're going to get deals done in the future are seller financing is back in style.
Oh yeah. Everything old is new again.
Yeah. Look for the assumable notes, strong banking relationships, and look for value add. Anything else that's going to get us through the next 6 months of multifamily investing that we're not talking about?
Well, I mean, I would add to that, if you're a player and you want to be an investor, write offers. I mean, Jared and I love groups that write offers, because if our buyer falls out, we're going to call the person who wrote an offer next, even if they're 10%, 20%, 30% below, versus all those people said, oh, well, call us if the price goes down. We've got 18,000 people in our database. I'm not just going to start it.
Right.
Anthony
Alfred Anderson and just work my way to Zed. We need offers in hand, because we've been surprised. Some clients say, look, I'm doing fine, I'm going to sell, I wanted this price, the market's reset. So markets are fluid that way. We've seen some groups say, I just don't know what's going to happen with interest rates, so I'm just not going to offer. Say, look, offer if interest rates go up, maybe you can't get the deal done, but maybe interest rates, the Fed doesn't move it as high. So I guess the punchline is stay active in the market, and trying to time markets is incredibly difficult. Dollar cost average is a great strategy. And to the extent you want to be contrarian, I'd say be contrarian if you're comfortable with it. I think the great sage investors in real estate and other assets are contrarian thinkers. If you're following the herd, you're probably not getting the best returns.
And as we go along too, if you're on the Zoom chat, feel free to send us questions in. We can answer them live. But we're going to go ahead and just take a question from the audience. If anybody has any questions, we can take one now. Drew.
I always felt with the group that I work with that in the past, non-refundable earnest money day one was the canary in the coal mine, that markets were starting to get overheated because you're putting up $500,000 on an asset that you haven't done very little due diligence on. But as time went on, it was like either you sit on the sidelines or you play the game. What I'm wondering is, how much are you seeing either in Ashcroft or here in the Seattle market, that not being a prerequisite to being one of the final bidders on a deal?
I've in the last handful of years, we've done $2 billion of apartment sales, and I'd say of all of those couple hundred transactions, we'd say under 10% have had non-refundable earnest money day one. It's just in certain really heated times, with certain like value add deal in a prime market in Bellevue, you might see that, but on average, we're just not seeing that much. I mean, so to me, the canary in the coal mine is just pricing. You just see pricing escalate and escalate and escalate, and then go beyond fundamentals. So I don't think that's as much of a deal term as an arbiter. When you're seeing that on every single transaction, it could be, but it's not a tool that's used so ubiquitously that we're using that as a benchmark. I think when we see pricing go beyond fundamentals, and so someone's offering, like right now, it's probably a mid 4 cap market. If someone's doing 4 cap deals right now, you got to wonder where their capital is coming from. But to me, that hasn't been a big arbiter.
Let's talk about rent control. I've got a question about that. You see that increasing, decreasing, staying the same, or do you see more cities potentially getting it?
Was a good question. So we've purposely been in the markets we're in because there's a lesser probability for that. In a lot of Sunbelt regions, we're heavy in Texas, we're heavy in Florida, we're not in California, we're not in New York, we're not in Illinois. But
you can say it, you're not in Washington.
No, okay. I wasn't going to go there. But nothing makes us immune. It's actually on the ballot for Orange County and out there in Orlando. Is that going to pass? I don't know. So hopefully it doesn't. I mean, obviously, as investors, that's not your favorite thing.
Yeah, I know that there was something on the news about Bank of America and the demanding that Bank of America make it cheaper for people to own a house. And they're like, well, then tell the Fed that.
Yeah.
So any concerns about that pressure sort of being put on multifamily? And is that a concern that you guys are going to be the scapegoat for interest rates rising and more rent control measures?
I mean, relating to the rent control question, I think about it, look at the areas that have rent control in the United States. They're far and away the most expensive markets for renters.
Right.
Mm-hmm.
And so it's because it limited supply. And so I do feel this demand maybe has shifted a little bit in, let's say, Seattle. And I think in the short term, there's a little pain, but it will get solved. If you're an owner, you'll be able to operate, you will cash flow. And what's happening is the developers aren't starting their projects right now, right? It's a lot of risk for them, especially the ones that are writing some bigger checks. And so with a constrained supply, you'll be owning, a more desirable asset, and therefore you may make your money through the appreciation, maybe less the cash flow.
Sure.
But I think that is the longer term vision or look. So if they do it, there's a place for it, but I'm not advocating for or against.
Sure. Let's talk about different markets. What markets are you most bullish on?
Well, I live in Central Florida. I've got to see that evolve since 2017. It's crazy hot. It's insane. We had the majority of our portfolio in Dallas, Fort Worth for many years, starting around 2015, and kind of rode that crazy wave. We've just been diversifying more. We're still very bullish on Atlanta and the submarkets there. You just have to look at where companies and where people are moving to and what those reasons are. And then you got to look at landlord tenant laws. You got to look at things like rent control, obviously. And so we're looking for diversification among the employment industry, right? So the last thing you want to do is be in, Detroit during the Great Recession where there's one major employer, that kind of thing. So like in Dallas, I'm sure it still holds true, but there isn't one sector that comprises more of 20% of the workforce. So you're very diversified that way.
Sure.
And the name of the game with multifamily, of course, is just that people have to be able to pay the rent. So if everyone's, employed by the neighborhood, whatever Caterpillar plant, and they go under, you don't have any payment.
Right. Right.
And that's as simple as that. So Sunbelt's been hot for a long time. We're still seeing crazy migration out of, California to Texas and New York to Florida and that kind of stuff. So into the Carolinas and Georgia. So that's still where we target. What we do, interestingly enough, I'll just share this too. We run our own in-house survey twice per year. We look at 200 major metropolitan areas. We look at average incomes. We look at jobs. We look at cap rates. The list goes on and on and on. We always seem to still, in the last 5 years, come back to the same markets that we're in.
Okay.
And we're not looking biasly that way to say, let's try to support these markets. It just lands in those markets for what we do and for our purposes. So
You guys commented on, kind of the more suburban bullish area, kind of around Seattle. Any other markets that you're really excited about specifically around Seattle?
I'm not excited about those. Everyone else is excited. So those are kind of,
Oh, I see.
I'll let you
Gotcha.
take one.
Yeah.
I'll see what's left.
Yeah, I mean, maybe I'm a contrarian thinker. I just look, if you look over time, the two factors that impact multifamily value the most is rental rates and cap rates. You want rental rates high and cap rates low. And those occur in markets that have the greatest desirability. In those markets, if you look at just the sort of structure of our economy, have been knowledge centers. And so I'm still bullish on knowledge centers that have long-term affordability. So California, unfortunately, Silicon Valley is not going anywhere, but affordability in anywhere near Silicon Valley and San Francisco is very tough. But I think Austin still has legs. It's going to have some challenges. I think Seattle has legs. I think Salt Lake City, I like the West Coast markets because those are the markets I know. And I'm bullish on Seattle. I mean, I'm super long on Seattle. You look at the tech employers here, most of what we do here is innovation and create very efficient companies. And so if you look at it, over time, I've said Seattle's been a 4.5 cap market, San Francisco's been a 3.5 cap market, and Vancouver's been a 2.5 cap market. So we've got a lot of room to run here. So I just like Seattle and in around. When I say Seattle Bellevue, but in and around here, and then just the multiplier effect for every tech job that comes up, there's 4 or 5 other jobs that are produced to cut hair and coffee and whatever else people need. And these people are moving south of Seattle and north of Seattle. They're moving east of Seattle, but that's a pretty expensive market.
I've heard a lot of questions about Phoenix. Phoenix is just absolutely blowing up and growing. Any thoughts on where that is today and where it's going to go?
Well, I'd like to get Jared's thoughts on
Oh, sorry.
where
Oh yeah, sorry, I didn't mean to.
No, not a far departure from Dylan's. I just think looking at our clients, we have the most respect for. They're what we'll call like institutional grade, but private. So started usually with 1 or 2 people and have grown it in 30 years to well over $1 billion and net value to those individuals. And so I won't name them by name, but there's 3 or 4 we just watched, and they were in the suburbs before everyone else is. And guess where they're going right now? They're going back urban.
Interesting.
So people I haven't seen even bid on an urban deal in 6 years are starting to write.
Wow.
And to me, it's just looking at Dylan, and we buy on a much smaller scale. what's a little more than a house, right?
Yeah.
And I'm just like, I guess we should buy an urban because they're doing it and they've done very well. So I think just broadly speaking, we have so much data with so many listings. That's a trend I'm just seeing like the very early signs of.
Yeah, I feel like people moved out to the burbs and they got bored and they said, okay, the cities are turned back on now. Let's go back.
Well, interestingly enough, within Seattle, I don't know the exact metric, but Dylan and I have been working downtown through the pandemic since I think June or July of 2020. I'd say it's still maybe 30 to 40% people back in our garage and just around the building. And so with that said, to see the rapid rent increases we saw end of last year, this summer, what happened? It was like talking to people in that age cohort that are living in most of the apartments. They're like, we just got bored. Like, where do I meet someone out in the suburbs?
Right.
So I came back to start like dating or whatever it is, to start living life again. And they're not even going back to work. So I'm interested to see what that next step will be when we're seeing a greater majority of people back in the office.
Yeah, it's very interesting. Yeah. Any questions from the audience?
I got a question. So for trending the correlation between the office vacancy and talking about urbanization, right? For Seattle specific, the vacancy of offices here in Seattle still seems somewhat high. I think it's double digits, 10, what is it, 10% somewhere around there. Anyway, are we seeing the population come in rapidly? I think this goes right towards your last response, Jared.
Yeah.
Are we going to start seeing that trend upward, downward as quickly as office vacancy goes up or down?
It'll be interesting because we're comparing, when I say, 30 to 40% people back, right? I'm talking about those people in the office that may be rented, right? So I do think probably what I'm thinking of is less so the office occupancy or vacancy rate and more so the number of employees at these larger companies that are back in their seats. Because right now Amazon's paying for every one of those leases, even though I think there's maybe 30 to 40% of people actually utilizing it. That's what I'm more watching. But it's a great question. I don't have a strong response because I don't do the office leasing.
Well, I'll say to that is just what we're seeing is South Lake Union. So it's a dense urban area in downtown Seattle. where Amazon has about 12 million square feet. So I was
We're in it.
routinely
Yeah, right,
talking
yeah.
to owners that owned buildings generally between 150 and 400 units. So we're talking 40 million to $200 million buildings. And their income collection during COVID was down, in some cases, 20 to 25%. So their rents were off by 15, 20%. Their vacancy was up from 5% to 10% vacancy. They are now, rents are higher, so maybe even 5% higher. So rents have now recovered by 20, 25% from the low. And occupancy is up to 95% again, but offices are only 30% occupied. So the people are back. And then imagine once those offices are at 70% occupied, even if not 100% occupied, it's just apartments are supply and demand. You
Right.
just have that many more people that are downtown. So that's the stuff that no one's talking about. They're talking about, are people going to work from home? What's going to happen? We're at the ground level looking at this saying, I like the idea of owning an apartment building that's at full rent when we're only 1/3% of office occupancy.
Mm.
But that doesn't make good headlines. What makes
Right.
good headlines is no one's ever returning to work and this is going to
Right.
happen and no one's ever going to live in a city again. But the fact of the matter is, we spent since World War II basically building up the suburbs. In the late 90s, we decided that was a bad idea. We started in early 2000s to urbanize, and COVID hit and we said, oh God, we're back to the suburbs, trying to reverse like 60 years of history.
Right.
So I think we are going to come back, and I think there's going to be what I call urban nodes outside of urban areas where light rail is and where, you know, MARTA goes to, that we like those urban nodes. But I think this mass suburbanization of the US is, I think that's some passe thinking. And generally the big investors are about 6 to 9 months behind.
Interesting. Very interesting. Alex, how are you underwriting exit cap rates? And the question for the camera is how are they underwriting exit cap rates?
We got into Amazon and we got a really complex tool called that magic 8-ball. And we just configured
Well, that's
that
a good
8
idea. You
ball.
should put like numbers in there.
Yeah, and just
I actually wanted to raise my hand. The audience member, maybe it was over the Zoom, that asked a question, and it was, what are you looking at when analyzing different LP packages? And that's my number one that I jumped to is exit cap. It's like, wow, 27 IRR, and oh, you're exiting at a 4 cap in 5 years. Like, I'd love to be there, and we might, but that's tough. So we've been growing them 50 to 100 basis points over the hold period. There's no proper way. It's like predicting a downturn. But once we get to in the urban markets around a 5 cap, I think people just, even if interest rates are 12%, I think a 5 cap would sell all cash to institutions.
Changing the methodology with the current rate environment.
Lots of
buyers or sellers.
Yeah. The buyers, yeah, they're definitely adding more spread. The metric we've seen a lot of people use when the interest rates go up, 1%, and cap rates go up half. So about a 0.5%.
That's typically what we do.
Yeah.
We'll worsen the cap rate over a 5-year hold by 30 to 50 basis points.
Yeah, exactly.
Yeah, we're doing a little more at Ashcroft right now. So, 4 cap to a 5 cap over a 5-year hold period. We historically have sold closer to the 3-year mark, but just trying to underwrite as conservatively as we can. As an LP though, and not everyone would agree with me or subscribe to this, but I've always just looked at cash flow as my number one metric. And, if I feel like that's conservatively underwritten, predictable and stable, that's what I'm basing the majority of my investment on, because I've had deals that are projected at 20% IRRs that ended up 12 because they couldn't execute the business plan, but the cash flow was there the whole time. And so that's how I invest.
And what it takes to get to that cash flow. You're talking about year one, but if you've got a 400 unit building and you've got to turn 400 units and raise rents $400 when base rents are $800, that might be a challenging business plan to execute on.
Agreed.
So it's not just looking at the numbers, but just how realistic they are in the environment.
Right. Correct.
Yeah, I value that deal. When you're doing cash flow in the first year.
Yeah.
Are you okay with a 5% cash on cash in the first year and getting to a 7.5, and then your 3 year popping 9, 10?
Right.
Is that a deal that from an LP perspective
is
comfortable?
Right.
And looking at that cash flow, assuming it's conservative underwriting.
Yeah, it's a great question. So this is why knowing your own goals and your own criteria is so important, because if you're not okay with a year one 5%, because you think, well, I'll go do a debt fund over here at 10% or something, and that helps you because you need the current high cash flow today because you're retired and you're living on that income, for example purposes, right? That may be a more appropriate play. If you're a long-term perspective saying, well, I still think it's reasonable and conservative, we're going to hit a 15+ IRR over 5 years, and I'm okay with 5% year one and working up to that, it may be appropriate for you. So I still do the majority with that hybrid in mind, but being okay at the end of the day with that 5 to 8% spread, we'll say, over the next 3 to 4 years.
So piggyback off of that.
Yeah.
If I come across a value add deal.
Yeah.
And they're telling me 8 cash on cash in year one.
Send it to me.
Send it to me.
Yeah. Yeah. Just,
Wondering how I'm underwriting that because they might be less conservative.
well, that's my point is you got to look at how they're getting there. It's not just that they're saying that if it's, we're going to do bridge debt in year 3, we're going to replace the current debt with this other debt that's fictitious right now. That's getting them to that 7.5 or 8.
Yes.
Be wary. But if it's just the fact that you've got a corporate tenant in there and in year 3, that corporate tenant's moving out and they can move it to market, that story that may hunt where someone else may not want to have a corporate tenant. So it's about the story and understanding, is it reasonable in this environment, and then stress testing it, how likely is it to occur?
I did a deal back as an LP back in, I want to say February, March, with a value add multifamily operator. It was not an Ashcroft deal. Texas, one of the biggest pain points is the property taxes being so high and the elevation after you close of what that could go to, and then having to fight and abate that stuff. So they're working with the local municipality to not have to pay the property tax for X amount of years. Therefore, to your point, being able to offer a higher cash flow amount for that period of time. So when you look at an Ashcroft deal next to that deal, it's a 6% versus say an 8%, to your point. But how are you getting there and why is that? And so you can get creative in strategies like that. You just have to understand how you're getting there.
Typically, you've got to double the property taxes in Texas pretty much during the whole period.
You have to be so conservative on your underwriting, it's ridiculous.
Yeah.
And then you have to hire third parties to help you fight that. So,
We're in Texas a lot. We have to do that every single transaction.
yeah.
Speaking of a strategy for taxes, property, have you done any entity purchases?
Good question. I shouldn't comment on that, but yeah, it's a strategy you can use. Yeah.
It can be a very good one.
It can be. Correct.
But on the exit side, sell.
Mhm.
Maybe look at that scenario as well.
Not yet.
Evaluation.
Not yet.
Well,
No,
we
that's a
do-
good point. Go ahead.
We're going to go ahead and wrap up the Zoom webinar. So for those that are dialing in virtually, just wanted to thank you guys for coming and watching this. This is going to be recorded. We're going to have a blog about it. You'll see it in our weekly rundown. We do a weekly email on Mondays that kind of summarize everything that we've gone. But I just wanted to thank everybody for coming. Thank you, Jared, Dylan, Travis, for the travel in. And we'll talk to you on the next First Friday.
Thank you.